All right, it is 11:30. Thank you for joining us for the 9th annual DICOM Loan Review Industry Survey webinar. That's a mouthful. This one is of special significance because it's my fourth one. No, that's not true, actually. It's of special significance because I've got a chance to collaborate with Kent Kirby. And Kent Kirby, while he needs no real introduction, he actually is DICOM's first client. He was the Director of Complex Risk at Commerce Bank, and now he joins us as Director of Strategic Solutions here at DiCOM Software. So really happy to have his insights coming in here today, and really happy to have such a great turnout. We have over 100 people that registered for the webinar, and I see more and more people coming in. So this is our best turnout yet. So very, very excited to get this underway and present some great stuff for you today. So a little bit about the webinar. The purpose is really for us here to take all the insights you have provided us from the industry and present them back to allow you to kind of compare your organization against other like-sized banks within your industry to see kind of, are we status quo? Are we a little different? And if we're different, do we want to be different? So it really helps you align for benchmarking and also drive continuous improvement in your organization. And now more than ever, we're going to try to offer some insights that provoke thought, and it's really for the benefit of loan review. And Kent is going to really drive home some new insights that I don't have because I don't have the perspective that he does in the industry. So we're going to be talking for about 30 minutes. It's possible we'll go a little longer, but we're going to try to keep it to 30 minutes. And just to let you know, all of you on the attendee side are muted, and that's not because we don't want this to be interactive. We just don't have the time for questions, and we want to eliminate background noise. However, we would ask you to send comments, questions, anything you can think of. You tell us we did a great job, tell us we should have done something different, whatever, even if you have an insight, send me and Kent an email. And we'd love to get some dialogue started and learn more about kind of what's going on your side of the fence and how we can continue to improve the industry survey. So we've got a lot of ground to cover. So I'm going to start getting into this. First, I'm going to stop here on this slide and just say thank you. These are outstanding participation percentages across all the real significant asset sizes that we target here. And this was done in the middle of a pandemic. Everybody was, running around doing a lot of different things. It was very discombobulating time, and still kind of is. But really appreciate those of you that took the time to provide us the feedback that you did. And as you notice, across the various ranges, we've got some great participation percentages of the total banks in each segment. So awesome job. Thank you for that. Without your participation, we're not really able to sit here and provide a whole lot of insight. So awesome. Want to start here and just kind of start very high level. And what we do is, based on the information provided by each respondent, we aggregate basically the portfolio composition for each bank's asset size. And what we find, some unique things this year, a little bit different than what we've seen in previous years. First, smaller banks, 1 to 5 billion, we're looking at a high concentration of CRE. When we look at the largest banks here, we're looking at really a large C&I portfolio. And then the real interesting takeaway here is we're finding a more balanced approach here in the $5 to $50 billion range, where C&I and CRE are a little closer and a lot more balanced. Typically, these have been very CRE heavy portfolios. So we're seeing a reinvestment in C&I. So that was an interesting little takeaway here. So starting off with everybody's probably favorite area, and I'm going to go kind of quick through this. And if you've been on previous surveys, you'll notice that a few of the slides are not going to be here. However, I am going to send the deck to everybody, so you will get a copy of all those great slides on department staffing and salaries. We're going to be pretty tight for today's purposes. And just wanted to show kind of the overall staffing levels across the various asset ranges. And we see, the small banks, 3 approximate total staff members, typically a manager and maybe a junior and senior staff member, all the way up to, the large banks. We're looking at staff sizes of 20 to 23 and up. One thing I will say is, if you fall kind of in the middle, if you're in the upper range here, you're probably somewhere in between. And, if you're a 40-something billion dollar bank, you're probably a little higher than 14, probably a little less than 21 if you're benchmarking. So this slide kind of will help you gauge how do we stack up against other banks our size. And then there's some other slides that you'll get after the webinar that will help even add a little more color to that information. So this was an interesting slide. And this was one that I've seen a shift. This is the 4th time I've done this. And in all previous years, we found that senior staff and management staff experience increases over the asset ranges, meaning a $5 billion bank typically hires folks that have less experience than a $50 billion bank. And we're not seeing that with the senior staff experience and the management staff experience, the senior being orange and the management being gray. And we do see a difference between the $1 to $5 billion range, but once you get over 5 billion, we're seeing really normalized results across the various asset sizes. And one thing anecdotally that I've seen that I talked to Kent about it, I've seen a lot of senior level folks here in these very large banks moving over to some of the smaller banks and taking on management roles. So what it looks like we're seeing, and we both kind of agree, is a shift of resources and something that illuminates things that we'll be discussing later on in the webinar about a real talent shortage. So we're seeing kind of other banks beg, borrowing, and taking resources rather than growing the junior staff levels up and senior staff in the management levels. We're seeing more of kind of just a shift of resources across different banks. So something that we'll be talking about further in the webinar as well. And then one thing that holds true is salary level does tend to increase as bank size increases. You can see some ranges here. The smallest bank junior staff levels 46,000 all the way up to 86 in the large banks, and you can read the rest. But this will be provided after this webinar and give you an idea how you stack up at your particular bank. So what we also did, we got a lot of feedback over the years that we love the salary stuff. Could you please regionalize it? Because I need to use a little bit more information to help drive some HR conversations. And we did that. So we have broken down the salaries based upon Fed Reserve District. And the 12 districts are illustrated here. And what we find is actually on the junior staff level side, whoops, let me go back to the previous side. The junior staff level side, what we're finding is that salaries are actually more volatile based upon region than they are bank size. We find the same thing here with senior staff sizes. We find that there's a huge range from the highest level Fed Reserve districts, Boston and New York, all the way down to the lower end. We're almost talking a 3-time multiplier, not quite, but almost. There you see a range there. And then the management level salaries still very, very reliant on region and very, very much so, even more so than bank size, but not quite as volatile as junior and senior level staffs. And we see a regional range of just under 100,000 all the way up to 148,000. So another slide that's important to take into account is bonus eligibility. And the takeaway from the last 4 years I've done this is approximately in the upper 80% range of banks tend to have some sort of bonus in place for their staff members, and the bank-wide pool tends to be the most popular option across the various asset ranges. Another slide that's been telling over year over year is C&I and CRE exposure per junior and senior staff reviewer. And we have seen this over 2-year increments from 2014 all the way to 2020 rather, increase significantly for all the various bank sizes. So there's a couple takeaways here. First, portfolio penetration, as we'll talk about a little bit down the road, has been consistent. So there's 2 ways to look at this. Either there's an increased workload on staff, or deal size has increased at origination or review. And it's one of the 2 or a bit of both. So I tend to think it's a bit of both. I think you are looking at larger deals and you're getting that penetration percentage through looking at less deals, but the bigger deals. But I also believe that you're also doing more work. I think it's a bit of both. So some takeaways here. I know this is a bit of an eye chart. You can get this delivered to you and study this, but really a couple key takeaways here is first, unless you're a really large bank somewhere above 20 billion, you're probably not going to have any admin staff in review. The other takeaway that we'll talk about a little bit further down in this webinar is that we're seeing more and more small banks leverage automation and technology. And what I think is happening, what I'd like to say is happening, especially through my experiences as well, And I think we're seeing some of the smaller banks are leveraging automation because it's actually cheaper than hiring admin staff, and you get a better return on investment because you get more than just horsepower. You get some other perspectives and some other capabilities. So seeing that trend, and we'll talk about that a little bit further down the road, a little bit in more detail as well. And then another thing that we look into is whether or not staff training is required for loan review. And we find whether or not you're a small bank or a large bank, you're likely to require loan review or training for your loan review staff. But then, of course, propensity increases to require training as asset size increases as well. Loan review productivity. This is an area that was a newer area that we delved into for the survey, and this was based a little bit of feedback over the years as I've been doing this. And we see a couple takeaways here. One is that most banks are tracking productivity metrics. However, as bank size increases, more likely to be tracking productivity metrics, or at least beginning plans to do so. And that makes sense. You know, larger banks with more complex processes and people got to dive deeper into KPIs and analyze their performance in a more detailed way. Smaller banks with 1 to 2 personnel, probably not as much. So that would make sense. And some overviews here. 62 banks overall, 62% are tracking metrics, 15% have a plan to start tracking, and 24% aren't tracking any metrics. And I know this doesn't add up, it's a rounding thing, but I presented them as they came out. So takeaway here, what are you tracking most commonly? If you're tracking metrics, most commonly you're tracking number of credits per week or per month by staff reviewer. That's the most common metric. Some more on loan review productivity. We calculate some averages across the various bank sizes of credits per week. And we're finding about 5 credits is about the sweet spot. Smaller banks tend to cover more files per week than larger banks, which would make sense, the deal size and complexity being a factor there. And then the peak efficiency really being in the $10 to $20 billion range, which I'm going to say that's because there's a lot of DiCOM clients in that segment. We'll have to dig into that a little bit more, but that's my take. So some highlights here. Banks of all size are more likely to employ a larger percentage of senior staff than junior staff. This underscores a little bit of that talent shortage that we've been talking about. Experience levels of senior management, senior and management staff seem to have normalized across all banks above 5 billion. So we're seeing kind of a trading of resources is what my takeaway is. We're also seeing that salary levels are actually more significantly impacted by region than bank size. And asset exposure per reviewer increases as size increases, and exposure per reviewer is trending up in all asset size. Needs a little more exploration as to whether or not that's deal related or burden related or headcount related. And then the average number of files per reviewer each week is about 5. And larger banks with more complex credits tend to deal with it. So some key takeaways there, and let's move on. Before we do advance this slide, Kent wanted to talk a little bit about the talent shortage. He dove into that in a little more detail. So I'll turn it over to Kent.
Thanks, Jim. You know, the survey really pointed out something that we've seen happen for a number of years, and that is that staffing is a very finite asset, and it's depleting. And I think there's 2 things that are going on. Number one is more demands are being made on your time. It's affecting productivity. So if you're not doing just credit review, you're doing other stuff, your productivity is going to go down. The other thing we're seeing, and it sort of showed up in the survey and some of our conversations this year, and that is from an industry standpoint, you're robbing Peter to pay Paul. So there's no, it's a net leakage in the loan review staffing. And so you're not getting new people internally, you're getting your new people externally. And I think this has short-term and long-term ramifications. From a short-term standpoint, the one thing the regulators have made pretty clear, regardless of whoever your primary prudential regulator is, if you're a 1 or 2 rated bank, they don't really want to be in your bank anymore. And I think the pandemic is now giving them the cover to get out of your bank. And so they want to, they don't want to be doing a lot of invasive file work. They basically want to be testing you. And so I think for 1 and 2 rated banks, you're going to see more and more reliance on the internal oversight functions, such as loan review and audit, and the examination regulatory aspect will be testing that. And so there will become more reliance on the loan review function. And if you're given all this distractions you have, what it basically boils down to is if you aren't automated, or if you're on some sort of alert style pseudo automated loan system, you got a problem. And I think that at this point, some sort of automation becomes a necessity as opposed to a luxury. And we're seeing that. We saw that even in the smaller banks. Historically, the smaller banks have said, we're not going to worry about it. But you're seeing that. And I think that's what's really coming out of the survey is that that this is really a trend and not an anomaly that's is taking place in the industry. And then the other thing I think you need to do on top of that is you really need to sit down and decide what matters in your review process. And I think that there's a lot of stuff that's going on because it's convenient since you're there. But if it really part of what your mandate is, and I think that for all of you probably read it, but the regulatory bodies put out a revised interagency guidance on credit review systems back in May, and they list the mandates, what their expectations are. And if you're not meeting those mandates, or if you're doing stuff outside of those mandates, then I think it's time to reassess what you're doing. Longer term, I think staffing is going to require some higher level attention. I think the regulator is going to push that. And so, it's not going to be training. It may not, there may be some, bringing younger people in and having them go through the ranks, but I think they're going to see more and more rotations going on. A lot of bigger banks, mid-sized banks have leadership development programs. I wouldn't be a bit surprised if part of that leadership development program is a rotation through credit review. That means that you need to have an automated process, because the last thing those guys want to do is try to figure out what the hell you guys are doing. And so if you have an automated process, then that allows them to focus on the work and then provides the insight and that you need not only from a portfolio standpoint, but also from their lending experiences as well. And I think the last thing is if you're building internally, you are going to run into some issues, because as these systems evolve and you need to get more and more attention done to them, one of the things that's happening in the industry, and we're kind of in this middle of this, is source systems are dying. I mean, our source systems are 45, 50 years old, and they're just dying. And so these are going to be replaced. And from personal experiences talking to other banks, these are multi-year projects, and they tend to be all hands on deck from an IT perspective. And so if you're really looking at an internal solution, I think you're going to have an issue, because you're going to be banging up against some other high priority items. So anyway, it's both a short-term and long-term issue, but I think it's something that we as an industry really need to address.
All right, thank you, Kent, and I'll underscore that last bullet too. The first thing I do when I talk to a new prospect is I examine their process, and when it's a manual process, I'm in awe of the amount of complexity that goes into keeping that process working. So yeah, simplify. That's my mantra. Thank you, Kent. So let's talk a little bit about the loan review process. First, we're going to look at banks' desire to outsource loan review, or propensity to outsource loan review. And what we're finding is a couple things, some things new this year. First, all banks over 1 billion are likely to insource rather than outsource. So that's not a new takeaway, but we do see propensity to outsource dropping with asset size. That's another consistent takeaway year over year. But what we're seeing differently is now, compared to last year, more banks are moving towards an in-house experience across all asset sizes. So that's an interesting thing that we're witnessing right now. And we're seeing that really the decision to outsource is also being influenced by different reasons than they used to be in previous years. It used to be all about cost. Now we're finding the lack of skilled staff, which is underscoring a lot of what we've been talking about of borrowing and stealing talent to try to ingest new talent into the organization. Now that seems to be a method of really solving the problem of finding lack of skilled staff. So we're seeing that as now the primary motivator to outsource. And then we look at the primary objectives of loan review. In the 4 years I've done this, and then I look back at another year, risk rating accuracy and asset quality tend to be top. From there out, they're all important, but you see diminishing importance across the line. So risk rating accuracy and asset quality. being number 1 and number 2. And then this question's almost a throwaway, but I bring it up because everything's changed so much now, and we're going to be recalibrating the survey to, capture folks that are working from home, either full-time, part-time, and what the impact that has on loan reviews. So again, this slide is a little bit moot at this point, but we'll be recalibrating the survey to better align with what's going on in the industry. And at this point, this is a slide that I usually kind of blow through, but Ken had some insights that he wants to share on this one. So I'll turn it back over to you, Ken.
Thank you. On the one hand, the pandemic has changed everything, right? So the way we do loan review today has changed very dramatically. Going back and looking at year-end statements just isn't going to cut it. And so I think a lot of loan review people are trying to figure out what the world they're going to be doing for the next year. However, the pandemic is a short-term effect. And at some point, probably within the next year, we're going to be going back to our more traditional way of looking things. And when I look at this chart, and I'm going to play a little bit of a devil's advocate, but when I look at this chart, it is the priority list of a 3 or 4 rated bank. It's not the priority list of a 1 or 2 rated bank. If you're a 1 or 2 rated bank, you have governance systems that work, right? I mean, that's the whole point. And certainly you want to test those systems to make sure they are in fact working as agreed, but it's a test. It doesn't become an obsession. And when I look at this priority list, it looks like it's an obsession. And so as a 1 or 2 rated bank, I think your real focus is on the outliers. So if you have new industries that you've gotten into, if you have new product types you've gotten into, if you've got new people, if you've changed policy significantly, those are the things that really become important. And sometimes I kind of wonder, and I'm getting a little ahead here, but I mean, we're so busy about hitting the thresholds that we want to have. I think it becomes much more important to look at where the risk really is. And if you're looking at a 30% threshold, that's fine, but I would rather you look at 18% of the portfolio that matters as opposed to hitting 30%. So just something to think about. Again, I'm not trying to advocate a wholesale change in business, but I do think we need to be looking at this a lot closer because I think we may have our priorities a little bit misaligned versus what I think the expectations are going to be, certainly from your board and your regulators. I'll get off my soapbox.
Good food for thought, and not totally unaligned with the user conference presentation where we talked about a paradigm shift in loan review. So lots of interesting things at play here. All right, so looking at approaches used to set review schedule, this is in line with what we typically see, but risk-based approach is the most common. We're also finding now with better technology and CQS in our clients' hands, we're also finding more sophisticated approaches to look at targeted portfolio segments, looking for those emerging risk segments through strong analytics. So we're seeing that on the uptick, and certainly we're aligned with that on the DiCOM side as well. Then we look at the top 3 selection criteria. Year over year, this is pretty common and not surprising here, but large borrower being the number 1, with 98% of the respondents picking that as one of their sample selection criteria. Then problem watch list loans and new loans lining up there as well. Then we look at types of loans in review. This is more a makeup of our survey responses than necessarily a focal point here, but we see commercial loans being number 1, CRE being number 2, construction being tied for number 2, and equipment as well, which is a newer survey response that we added, I believe, last year, the year before. So we're seeing those being the primary types of loans. Then we look, most respondents are reviewing at the relationship level. That's been a trend years back. It's now becoming the norm. So that's something that we're underscoring here, but no shift in how that's been approached. Then we look at target penetration percentage, and we talked about this a little bit earlier. These ranges have been pretty constant over time, and we're looking at the smaller banks are somewhere around 43% overall targeted portfolio penetration percentage, with the larger banks a little bit under 30%. So we see that shift occurring across the asset ranges. And C&I and CRE pretty consistent across the various bank sizes. Then where exceptions cited, typically cited at the bar of 11. We'll move on. And how do exceptions impact a review rating? This is another one that got Kent thinking, so I'm going to turn it back over to him and let him talk.
For those of you who know me, know that I'm not a very big fan of exceptions, which is probably something of an understatement. But quite frankly, this slide irritates me. And as a consumer and a long time consumer of your product, don't waste my time. And you know, if I have a loan to Amazon, a term loan, and I don't have a loan agreement, so what? I don't care. Okay. I mean, I know I don't have a loan agreement. I don't care. Don't give me a bunch of stuff that gums up or hides where the issues are. And so when I see, yeah, we're going to cite all the exceptions, but we're only going to count some of them, that just gums up the report. So just think about that. I mean, really, I could probably spend a whole hour just on exceptions, and I won't, but they need to matter. I mean, they really need to, what's impactful and why, and what needs to change to make this portfolio a safe and sound portfolio. So just something to think about. But I think sometimes if you report too much, that's even worse than not reporting enough. It's just something to think about.
Good food for thought. Don't waste Ken's time, and potentially don't waste your own. So a little counterpoint there to consider. Now, a slide that's near and dear to my heart, and now Ken's heart as well. But this is where we look at whether or not various bank sizes are using manual processes or automated processes or an automated system to perform key aspects of their loan review. And what we're finding, which I love, is banks under 10 billion are becoming more likely to automate. It's almost not quite becoming the norm, but it's quickly becoming. Hopefully next year we'll be reporting that it is the norm. And then we're looking at all banks above 10 billion. We're talking about all well above 50%. It is the norm. If you're a bank above 10 billion, you're probably using a system. If you're not, time to just check it out and give me a call. Me and Kent would love to talk to you. So then we also parse things out by whether or not various bank sizes are using a vendor supplied automation system, a automated but custom in-house built system, or still leveraging manual process. What we find here is the mid-sized banks are more likely to buy a vendor solution. We do find the very large banks are likely to build their own system. But what we're seeing is those systems tend to have a shelf life, and those systems tend to last 3, 5, maybe a little bit more years. And then those large banks start contacting companies like DiCOM to say, hey, do you have a system that is scalable and that will last, you're going to invest in technology and in innovation throughout a longer life cycle? And the answer is yes. So we're seeing a shift there in the larger banks as well. And then the smaller banks I've mentioned already, some pretty high percentages that are likely to be using automation. We see still 65% manual processes in the $1 to $5 billion range, but as soon as you get out of that, automation becomes the norm, and we'd like to see that continue to change. Some highlights. All banks above 1 billion are likely to keep the review function in-house, and the talent shortage seems to be the new primary driver of why some banks look to outsource the loan review function. Targeted portfolio penetration drops as bank size increases. The likelihood to utilize manual loan review processes trend down as asset size increases, and we're seeing a shift for manual processes in the smaller banks. And larger banks have a higher propensity to build their own, but we mentioned those in-house systems tend to have a shorter shelf life, and now that a lot of those larger banks are reassessing whether or not to continue to invest in that aging system or buy a vendor managed system. Supply system. So let's talk about the credit risk management process and reporting lines. I combined these two sections this year, and it will hopefully flow a little smoother. So we start and we look at other responsibilities of loan review. Last year we noted that there was an uptick in a lot of areas and a lot of comments in the survey too. That man, we're just getting pulled in so many directions. This year, it looks like a lot of the same. We're seeing acquisition due diligence is still the most common additional responsibility, and that is increasing over the years. From 2018, it's gone from 61% to now 3 out of 4 banks loan review is responsible for that function. And we're seeing, preparing, managing regulatory exams, another one. And then a lot of these are ticking up a little bit. So we're seeing that, you're under a lot of stress to do a lot of things. We get it. The use of 1D versus 2D risk ratings, really smaller banks under 20 billion likely to be using one-dimensional risk ratings. If you're over 20 billion, you're likely to either be using two-dimensional risk ratings or transitioning to do so. Who has the final say in loan review grading? The loan review manager, and that's been consistent year over year. We'd like to see that, and that stayed consistent this year. Looking at the reporting lines, this is one that we've seen kind of CRO, kind of number 1, number 2, and this year it's number 1 really when you look at both direct and indirect reporting lines, and that's seen a shift over the years. Kent was able to point that out even more than I've seen, but used to be the CCO, and then over the years it's become the CRO, which has implications on how the departments run, and Kent's got a little bit of insight on that further on. We're almost done, by the way. Then we look at management reporting. The line of business and executive management, we're looking at sending them detailed reports on a monthly basis. However, when we're talking about the board, the various committees, we're talking about high-level reports on a quarterly basis, so a few times, 4 times a year, more high-level information. We look at the acceptable level of adversely classified assets as a percentage of Tier 1 capital in the ALLL, and we're finding that really between 13 and 17% is the norm, and that's what we would expect to see because regulators want you under 20, so it looks like for the most part everybody falls into that category that we'd expect to see. Same thing happens with acceptable level of criticized loans. We see an acceptable range here from the survey respondents between 3 and 5%. So if you're in that range, you're in good company. Some section highlights. Acquisition due diligence still remains the number 1 additional responsibility of loan review. 1D risk ratings, still the norm for banks under 20 billion. Most common reporting line combined indirect and direct is the CRO. Loan review typically provides detailed reports on a monthly basis to the line of business and executive management. Average acceptable criticized loans is between 3 and 5%. Average acceptable classified, 13 to 17%. Now, some final thoughts from Kent as we wrap things up.
Okay, I'll try and make this fairly brief. The first is something I've already talked about, and that is that your staffing is a finite asset and it's getting older. And I don't want to be overly dramatic, but I think at this point it's not just an academic exercise for credit review. It's really becoming an existential issue, and something needs to be addressed both on a short-term and long-term basis. On the surface, the survey tends to show that the smaller banks are more productive than larger banks. I think this is more a function of the extra demands on a larger bank's time. It gets back to, as I said, the interagency statement that came out in May, and that is, what is it you're doing, and does it really matter to the loan review function, and is it better handled by somebody else? Sometimes convenience is not necessarily the best way to go. The third thing that we're starting to see a shift is that more banks are starting to bring the loan review function internal. Staffing does seem to have more of an issue than it has in the past. Automation does seem to be the way to go, and in-house systems do tend to have a shelf life. So it's just something to consider. But as you, especially if you are currently outsourcing that function, as you bring it in, these are issues that you need to consider. The next thing that comes up, and I sort of skipped it, but I want to go back, and that is that the longer-term shift from credit review from credit to risk, I think has some very serious implications. And if you look at the risk officers, the chief risk officers of banks, they're not credit people. The chief risk officer at Morgan was a trader. The chief risk officer at Citi was a trader. So these are guys who are more process oriented as opposed to content oriented. And so I think that does have implications in how credit review is doing its work today versus how it did it 10, 12, 15, 20 years ago. And again, we don't have time to talk about that and explore, but I do think it's something that we need to be thinking about in terms of how we're doing our business, and are we being consistent with the regulatory expectations that are laid out in the interagency guidance. And the last point is the pandemic changes everything, or does it change everything? And so we're going to find out. And so what I want to invite all of you is that when the next year's survey comes out in February, please participate, because there are going to be some additional questions trying to explore this in more detail.
Outstanding. All right, let's bring this home. Appreciate it. Looks like the vast majority have stayed with us a little bit over time. So we will distribute the full deck to all participants. That includes some slides we didn't go over today. So, excited to get that in your hands. And we're going to be working on the white papers. The white paper takes a deeper dive into certain areas of this survey, some of the things that Kent's already touched on. And we're going to be working through that, distributing that in Q4. So sometime in the October timeframe, expect to see me reaching out to you on that one. And then that follows right into connect with me and Kent on LinkedIn if you're interested in this stuff, which I believe you are, and also follow DiCOM. That's how you make sure you get the notifications for the white papers and all the content that we're putting out. So please do that. And then we want to hear from you. This is our contact information. You're going to get it in an email as well, but we want to hear about, what are you experiencing? What are your challenges? How can we help solve those? And how can we better understand the industry and where it's going? So we couldn't be more excited about the turnout we had today and the prospect of continuing this dialogue with a large number of you going forward. So thank you very much for your time on behalf of me and Kent. And Kent, thank you for your participation this year. I'm excited for many more to come. Thank you so much.
Thank you.
All right.